So, Kenneth, we know that ESG, or environmental, social, and governance structures, are high on the agenda for insurers. Last year, Lloyd's of London said they would step back from insuring coal and oil sands. Now they're saying they'll design insurance for electric vehicles and also look at ways to ensure the transport of hydrogen. Kenneth, how do you see these transitions to more sustainable insurance products playing out? And can sustainability really lead to profitability?
So, Abby, I would take issue with even the framing of sustainability and profitability as trade-offs, because I actually don't think that that's a I think it is not a trade-off that is real to me. I think it's often framed as such to say, oh, you can only do sustainability and have sustainable business practices at the cost of profitability. But your Lloyd's example is a great example of saying insurance will actually support and move with the market and move with industries as they move to more sustainable energy sources. So, the shift that insurers are making, the shift that Lloyd's is making, simply reflects a recognition of where the market is, and the assets and the insurance that's provided in those new sectors will be, just as profitable as the traditional energy sectors used to be. And so, I think there's definitely a role that insurers play in creating the products and creating the capital backstop for these new energy sectors, and they play an important role in actually encouraging those migrations by having those products available. As you may imagine, it would be very hard for energy companies to make that shift if they couldn't get the insurance they typically have in place for the traditional power in the new sectors as well. So I don't think it's a profitability trade-off at all. I think it's insurance recognizing that there are new ways in which the world is operating and having its products and services match that, right? And beyond even just moving with the market, there are ways in which I think insurers are able to move into new sectors and profitable sectors that weren't in place before. A great example of that is in this notion of underserved markets. And if you use the traditional black box underwriting approaches, very often there were swaths of the market that were not very attractive from a pricing perspective, and regulation had to step in to make sure that those markets weren't redlined away by insurers, right? In the new world, where we actually have the ability to look at much more usage and behavior-based and sensor-driven insurance offers, sustainability in one of its flavors is actually closing the gap in these underserved markets with much more tailored pricing and products. So I'm very optimistic, and I'm very bullish about the role that insurance plays, both in encouraging and supporting the move to these sustainable business practices, and really helping amplify and accelerate them with some new approaches to underwriting and some new ways to go into these currently underserved markets.